Okay, good afternoon, everybody, and thank you for joining this InvestEngine webinar in partnership with J.P. Morgan Asset Management, which is all about targeting outperformance with active ETFs. I'm Andy Prosser. I'm the head of investments at InvestEngine, and I'm joined today by Ruairidh, who is an investment specialist at J.P. Morgan, and Ted Malcolm, who's the head of UK ETF distribution, also at J.P. Morgan. Now, in terms of the plan for the webinar today, I'm going to hand over to Rory and Ted in a second, who have a presentation they're going to run us through. I think the plan is that Ted's going to start off by covering the growth of active ETFs kind of in general to start with. And then Rory's going to dive into a bit of the detail on a couple of specific active ETFs. After that, I'll do a very quick demo of how to find these JP Morgan ETFs on the InvestEngine platform. And then we'll have a Q&A with Rory and Ted for the last kind of 10 minutes or so. Now, if you do want to ask questions as we're going through, you can click on the Q&A button in the bottom of your screen. The questions won't be broadcast to the whole webinar chat. They're just going to come straight to us. So don't worry, no stupid questions, just ask away, and we'll answer as many as we can at the end. Now, it's my job also to make sure that everything runs on time. And I've seen your slides, Rory and Ted, so I know there's a lot that you want to get through today. I just need to make sure I leave enough time at the end for the quick platform demo and the Q&A. So I'm hoping that once we've wrapped everything up, we'll be ending the webinar at about 5:45. Right, before we get going, the last thing that I need to mention is the usual disclaimer that your capital is at risk whenever you invest. This webinar is for UK clients only, and that none of this is financial advice. Okay, without further ado then, I will hand over to you, Ted, to get things going and tell us all about what active ETFs are and why they're growing so quickly.
Great. Thanks, Andy. And thank you all for dialing in. Great to be chatting with you today. So as Andy said, what I want to do is just give you a really quick overview or update for those of you who heard from us before around what's going on in the active ETF market, because it's a market that's growing incredibly quickly. There's lots of innovation coming to this market. And so hopefully something quite exciting for you guys to keep an eye on, and hopefully also some interesting investment solutions. And on that, as Andy said at the start, delighted to have Ruairidh here with us today, who sits with our equity investment team, and so obviously knows these investment strategies incredibly well. And we're going to walk you through two different types of strategies that we run via an active ETF that we think are particularly compelling in the current market environment. So we'll walk through that and spend the bulk of the presentation on that. And as Andy said, very happy to take your questions at the end on those. So on this first slide, a pretty traditional graph that you see in ETF land, which just shows that the ETF market continues to grow and grow. This is all ETFs. We're not talking about active ETFs here. What we're trying to demonstrate is this market has grown phenomenally since the early 90s when it first launched into a $15 trillion market. Very much started off in the US. But as you can see in that box in the top left, over the last 10 years, actually the ETFs that are bought and sold here in the UK and Europe have actually grown in terms of assets a bit quicker than the US. And that's as all of us probably on this call who use ETFs have started to adopt them much more in portfolios. And so from my seat, where I see all types of investors, whether institutional or retail clients, we are really seeing ETFs being used more and more for various different reasons. And we see the active ETF story, which we'll come on to in a second, as just the next innovation within this great market that continues to grow at double-digit growth year on year. What we're going to do here is just give you a bit of flavor of what's going on in active ETFs. There's a lot of numbers here, and maybe you can look at this in your own time. But what I'd like to point out really is that, yes, it's still a small market because it's a very new market, the active ETF market, but it's growing incredibly quickly. Again, like the overall ETF market, starting off in the US, that's where the bulk of the assets still sit today. But over here in the UK and Europe, we're really seeing investors looking beyond ETFs purely as just passive building blocks. They're now looking at them as a fantastic vehicle that comes with loads of benefits that we all know about and we'll come on to in a minute. But now you can access high quality active management via that ETF vehicle. The numbers I'd call out, if we're going to look at numbers on this slide, would be that, yes, the market is small. So globally, active ETFs make up about 8% of the overall ETF market. But last year and this year so far, they were capturing over 27% of all the flow going into ETFs is now going into active ETFs, which means that we're going to see that 8% number creep up over time, which is great. Another way to look at this, and I think this is more important for you as the listeners and users of ETFs, is Yes, it's great that the assets are growing, and obviously asset managers love that. But for you as investors, what you want is choice. And obviously, you can go via the InvestEngine platform today and get a multitude of choices when it comes to passive ETFs and obviously increasingly active ETFs. And I think this chart really just demonstrates where we've come from, but also where we're going. And so you can see the gray section in this chart is what the number of passive ETFs, and the green is the number of active ETFs. And you can see that number is really increasing in terms of active ETFs, now making up 36% of all ETFs are active ETFs. The bit to the right of the chart, the pie charts, I think this brings us to life even more. So looking at the last 12 months, out of all of the new ETFs launched or issued, you're seeing that in the US, 84% of the launches last year were active ETF launches. It is all about active ETFs in the US. Here in Europe and the UK is below the chart, obviously a little bit behind, but still 30% of all launches we saw last year were active ETF launches. And so hopefully for all of you who maybe buy into the concept of active ETFs, you're going to have a lot more choice available to you as asset managers like ourselves who have active backgrounds are now going to be giving you the opportunity to access hopefully high quality active strategies within the ETF. Why does all this matter? You can get active management via mutual funds, investment trusts in the UK, obviously, but this blue part of the pie chart, event diagram, sorry, really brings to life, what the ETF vehicle can bring to active management. I'm not going to go through all of these, but just to call out a couple, which I think are the most compelling. Top one, transparency. You as an investor, whoever you are, whether you're a retail client or institutional client, you can see exactly what we are doing with our portfolio, what is inside our active ETF. Historically, that was not the case with other structures. You'd often get a fact sheet with the top 10 holdings, and that was it. Whereas now, on a daily basis, even though we're active, you can see exactly what we own. So you've got a really good grasp of what we as managers are doing with your money. The other piece is around cost. Yes, ETFs got famous for being low cost, and that's because they were predominantly passive. But even actively managed ETFs, even though we're looking to deliver excess return over time and generate that alpha, we can still do it in a cost-effective way. And so hopefully that's really appealing as you try to build cost-effective portfolios. And the last thing I'd say, and particularly in the context of active management, is that historically accessing active management, was sometimes expensive, but also hard in terms of, maybe high minimums to get into some of these funds and structures. The beauty of ETFs is you can go on InvestEngine today and buy one share of our ETFs, and that gives you access to some of our best active management. And again, hopefully at a reasonable price. So that's why we think pairing active with the ETF vehicle is hopefully a really good outcome for you as investors if you do your research correctly. So I'm going to leave it there on the background to the ETF market. We provide loads of content on this, and obviously via InvestEngine, hopefully we can deliver that sum to you over time. But let's get into the solutions. So there's two major ones that we want to cover today. And the first one we're going to talk about is what we would describe as a kind of core equity solution. This should be at the core of your portfolio. This is a kind of buy and hold solution that's similar to passive, but gives you something else. So Ruairidh, maybe if you could give a bit of background in terms of the strategy, the research enhanced strategy that we're going to talk about and the kind of team behind it.
Yeah, perfect. Well, first of all, thank you for the introduction. Thanks, Andy, and it's great to be here with everyone. So if we jump to the next slide, and we can, sort of go into the details, right, on what it is we're trying to do here. I think I just call out a couple of things that Ted mentioned. Firstly, everything we're going to talk about today is an active ETF, even though we're talking about ETFs, all of this is active. And what you'll see as we go through this is even though we launched these products in 2018 as ETFs, these capabilities have existed for a really, really long time at JP Morgan. And really what we started with was trying to bring really the best strategies, we had into the ETF wrapper and to try and open up to a whole new spectrum of clients. So when I joined JP Morgan 12 years ago now, it's gone pretty quickly. A lot of my time was spent talking to big institutional investors about these sorts of strategies. The last couple of years has been spent talking to ETF clients, which, as you've seen, has been where all the growth has been and quite frankly, where all the excitement has been. But these strategies, again, flagship strategies, some of the largest active ETFs that we have in Europe, and they sit within our research enhanced index range. And enhanced index is the sort of key word here. You can see some of the benefits of enhanced index on the left-hand side, but where I want you to focus on first is just this graphic on the right, which I think is a really good illustration of what enhanced index is trying to do. So if you think of your traditional passive index fund, I'm sure a lot of people dialed in right now will use them already. That's your sort of green square there, trying to give you 0% alpha or 0% excess return, and basically track the index as closely as possible. As you move up that blue dotted line towards, a traditional active fund, to generate, increasing amounts of excess return, or put simply, to deliver a return better than the benchmark, the index, you need to be different, right? You got to do something differently. And tracking error is a sort of measure of how different that active fund might be from the index. So if you think of your traditional active fund, picking the best stocks they can, if they get that right, great, they've made it. And if they get that wrong, you can underperform the index. That range of outcomes is basically the tracking error. And as you can see on this chart, to generate increasing amounts of excess return, you've got to take risks, you've got to take tracking error. But enhanced index, as you can see that purple square there, is trying to generate positive excess return, but much lower levels than you might expect from a traditional active fund, but also at much lower levels of tracking error versus a traditional active fund. So we think, when you get enhanced index right, you end up with a product which looks very similar to the index, but uses active management to try and outperform the index. And the aim of the game here is, if we can give you, a little bit of excess return and try and do that as consistently as possible, then over a long period of time, we all know about the compounding effects of interest and compounding effects of return. That should create quite a meaningful difference versus investing passively. The final thing I'll say here is that keyword research. So a lot of people do enhanced index, a lot of our competitors do enhanced index, but what really I think sets us apart is research. We use bottom up, fundamental stock research to construct these portfolios. And, very simply, and we can dive into it in a bit more detail later, but very simply, what we're trying to do is own a little bit more of the stocks our analysts think are the best, own a little bit less of the stocks our analysts don't like as much, and do so where it looks and feels like the index. So all of that tracking error, all of that sort of range of outcomes difference versus the index is driven by bottom-up fundamental stock picking. We can see how these strategies have basically performed. And so remember, I said at the outset, when I first joined J.P. Morgan, I spent all my time talking to big institutions about these sorts of strategies. And here you can see the performance of those strategies. So we've been managing the global strategy since 2003. This is the data for that strategy here. And each bar you see is an annualized 5-year number. And we've taken all of those observations over quarterly. Slide really shows you this is telling you that if you bought the strategy at any point over the last 20 years and held on to it for 5 years, then you've always seen positive annualized excess performance. Now that's pretty unusual, right? There's not many strategies out there that can say they can do that. So this again goes back to what I said. We're really trying to get the best of JP Morgan and put that into an ETF wrapper and open it up to a whole new spectrum of clients. I think this chart shows that. And the second piece I'll just mention here is the tracking error. So again, that's how different you are from the benchmark. And you can see how low and consistent that has been. So this is really where the role of the portfolio managers comes in. We want to make sure that as much as possible, that tracking error budget is driven by bottom-up fundamental research, something we think we're really good at. The sort of final thing, information ratio, that's basically your excess return divided by your tracking error. It's a good measure of how sort of efficient and how good the manager is at sort of managing money. Your sort of academic textbooks will tell you anything above 0.5 is good, and anything above 1 is really very good. So these are, high information ratio strategies, really efficient ways to invest in equities. We can talk a little bit more about the team behind these products. So on the top half of this slide, you'll see the portfolio managers. So a global team of them based around the world. What I just want to highlight here are you'll see the numbers beneath the names of these portfolio managers. The first number is years of experience in the industry, and the second number is years of experience at J.P. Morgan, at the firm. And I think what we can all see from this is a really, really experienced team, not just in the industry, but also at J.P. Morgan. These guys have been working together for a really, really, really long time, managing these strategies. We've really got experts behind these ETFs. The second piece I'll mention is this research team. So again, the key element here is we've got the portfolio managers working with the research analysts to make sure that, we're overweighting the names we like the most and underweighting the names that we like the least versus the benchmark. And again, you'll see that these research analysts have really decades of experience. If we go to the next slide, I just want to have a brief word on these research analysts. And there's a lot of numbers on this slide, but what I want you to take away from this, the three key numbers on the left, which I'll call out. 80 analysts around the world. So that's a large number of research analysts located in the US, Europe, Asia, emerging market companies. And again, they have decades of experience, and they're trying to identify what they think are the best, and perhaps what are the not so good companies out there. And together, this team covered 2,500 companies globally. So if it's big and important, we cover it. And we also spend $150 million a year on this research team. So, we think it's a big, powerful research platform. We think it's world-class, if not world-leading. And it really underpins, absolutely everything we do in these sorts of strategies.
So Rory, I mean, obviously amazing resources. It is really kind of unique to JP Morgan, the size of the research team and obviously the experience and the portfolio management side. How do we bring all that together into what is quite a simple product, to be honest, isn't it? I mean, it's obviously passive-esque, it's enhanced. How do they go about constructing the portfolio? What does it look like from a top-down perspective?
Yeah, so hit the nail on the head there. It's simple but powerful, I would say. And on the next slide 13, you can see how this comes together. So remember I said at the outset, these products are meant to sort of look, feel, smell, like index funds. So they have similar region weights, you can see here, and similar sector weights. But where the sort of edge, where our sort of difference versus the benchmark or the index really comes in is at a bottom-up stock level. So we want to own a little bit more of the stocks we like. So on the far right-hand side, you can see the European retail sector within the global product. And you can see we own a little bit more of names like Richemont, which is a European luxury company, Tesco, and Next. I don't think I need to explain. I think everyone knows what these companies do. And so we like those stocks. We think they're really interesting long-term investments. So we own a little bit more. And on the flip side of that, we own a little bit less of names like Hermes, again, a luxury company famous for making ties and handbags, and Kering, another sort of luxury company there. So, we're only a little bit more of the stocks we like the most, a little bit less of the stocks we sort of don't like as much. And the key here is, I've just spoken to you about the European retail sector, but we're doing it in every sector, in every single region across the world. And because of that, I think you get a lot of consistency, basically, in this performance.
No, very clear, and it's conscious on time. So it's a rather crass to go straight into performance, but I think, in the interest of time, just to show that this kind of process does work, maybe we just have a couple of comments on that.
Yeah. So on the next slide, again, I think a really nice illustration of what it is we're trying to do. So if you just focus top left on the global strategy versus its benchmark MSCI World, at the very start of the chart, there's like no difference between the blue and the yellow line. That's good because it looks, feels, behaves like the index. But over time, that little amount of excess return that we're trying to generate should compound into quite a big difference versus the benchmark. Can't outperform every month, every quarter, or every year. But if you give us long enough, call that 3 to 5 years, we're very confident in our ability to generate excess return. And you can see that's a similar pattern for all of the products that we have on the slide. All of the returns here are annualized and they are net of fees. So fees are 25 basis points or 0.25% on the global strategy.
Just before we move on, just a couple of questions, please. I was hoping you're going to freeze the slide on that one because I think that's a really important one to show. Firstly, Rory, what sort of investor would these ETFs appeal to? And secondly, kind of related, how should they be used in portfolios? Should these be replacing your core ETF exposure? Should they be used more as satellite positions? A bit of both. How are you seeing your clients using these?
Yeah, I would say that these ETFs are basically suitable for everyone. If you're currently using passive equity products, I think these could be a great either complement or substitute to them. I mean, ultimately, we've designed these products to be replacement to passive. They get you that passive-like exposure, but we can give you access to active management to try and outperform. So we see some people replace all of them, replace all of their passive products, and we say some people doing a 50-50 of them. But really, I'd say they're suitable for absolutely everyone. The next slide, I just wanted to have a quick word on our range. So I've spoken about the global product. In ETFs, we love a ticker. So here are the tickers for all of the different regional flavors that we have. So, I've talked about global, but, if you're interested in a European product or a Eurozone product or, a China A-shares product, we have those capabilities. And this is a good snapshot of everything we have in this space.
Just to be clear on the InvestEngine side, we obviously only have the sterling lines of these ETFs. So just for clarity, we have loads of the REI products on the platform. But just to shout out some tickers, just to kind of direct people, we have JGRE, which is the global REI sterling line. We have JERE, which is the Europe version, and JURE, which is the S&P 500, if you're trying to find them on the platform.
Perfect. And you took the words out of my mouth. Yeah, it's always confusing, but yeah, we often, well, actually with all our ETFs, we offer a sterling trading line on all of these, so you should be able to access them via the InvestEngine platform. Well, one thing I noticed sort of anecdotally is what's been fascinating that this year, with obviously all the market volatility that we've had, particularly in the US, is that we had so many clients, obviously in the ticker JREU, the US equity one, but we've seen significant money move away from that into more global exposures to be more diversified, but also into Europe as well. And that's the nice thing about REI. Once you understand the process in one, it's very repeatable in the other building blocks. So you can play between the different regions, linking to your macro view of the world. Right. I think, conscious of time, I want to move on to the next strategies, which again are quite different. So those are core solutions. What we're going to focus today on what we call is outcome orientated investing. And there's a very clear outcome with these investments, and that is to deliver a high level of income. So these are income investments. And so obviously the most used case when we're talking about this is for delivering you a nice income, which we pay out monthly if required. But also the dynamics and the nature of the way the portfolio is constructed, it actually kicks out some quite attractive risk-adjusted returns that mean it can be used not just purely as an income solution. So Rory, can we kick off just to give the audience a bit of a feel for what are these? How do we build them?
Yeah, so these have been, really cool products to have, and as you mentioned, have been really, really popular, particularly this year. If we go to the next slide, as Ted just mentioned, these are income-seeking ETFs, and I always say that income is one of those things that never goes out of style. Who doesn't like getting income, seeing that hit their account? But traditionally, there's been quite a big trade-off between looking for income and generally accessing those sort of investments. And what I'm trying to show here is split of different asset classes, so alternatives, equities and fixed income. If you look at the sort of left-hand side of this chart, so the alternative products in blue are great examples of this. Really nice income levels, but really hard to access for the sort of individual investor like us and like many people on this call. Often need really, really high minimums. So you need millions to sort of invest. You can trade into them daily like ETFs. Often you have to wait each month or each quarter. So can be really difficult to access. Look on the far right-hand side, traditional sort of equities, US equities and international equities, and the yield is, nowhere near as exciting as it is on that alternatives. So what we're trying to do on these sorts of products is create something which delivers a high level of income, but is also, accessible in the ETF wrapper, and with that brings all the benefits you've just discussed. And if we go to the next slide, we can talk about our suite of products that we have in this space. So we have, JEPG, J.P, and JEPQ. So we've got global, US, and NASDAQ or technology versions of these strategies. And ultimately, what we're trying to do is we're trying to use underlying sort of actively managed equity portfolios with an option overlay on top of it to deliver really high levels of income. So you can see here on this slide, 7 to 9% income annualized in a global and US, and 9 to 11% on the tech strategy. So really, really high levels of income, and income you probably wouldn't really expect to get from equities. I know we can move on to it a little bit later about where that comes from, but a bit of income from the equity portfolio and a bit of income from selling options.
On the sterling side there, just quickly for the sterling lines, if you just flip the last two letters of each of those tickers, then I think you get the sterling lines for those watching, and they're all available on InvestEngine. So, for example, JEGP, JEIP, and JEQP should all be findable on the platform.
So yeah, let's dig into a bit more. So how are people using this? Is it purely just getting that yield and nothing else, or is there a sort of return component that comes with it? And so if we can maybe have a think about how investors on this call could use these products.
Yeah, so I'd say they're pretty versatile. So on the next slide, we've seen people use this really in 3 different ways. And the first is obviously income generation. If you're looking for that income, you need that income. And these strategies can be a really interesting way to get income from what is often really, quite a differentiated source. So, these strategies offer consistent stream of income paid out monthly. They can be a really interesting, either substitute or complement to existing, equity income strategies that are out there already. The second way we've seen people use this is as a conservative equity market solution. Now, this is where, I think they've been really popular this year, particularly with all the volatility, all of the uncertainty we've seen in markets, and just the volatility we've seen in equity markets. We've seen pretty much a sort of V-shaped recovery. We saw markets really sell off a lot and come back, and it doesn't seem that much more certain to us about where markets are going from here. And these strategies, by nature, in the global and the US one, if we take as an example, we start with an underlying equity portfolio, which is a bit more defensive, a bit more conservative, has a lower volatility than broader equity markets. So when markets fall, that portfolio should fall less versus the market. And we're generating really high levels of income from options. And when volatility is high, the income we generate from the options increases. So if you just sort of think about the environment that we've had, recently, uncertainty, a market falling, and these strategies have fallen less and delivered higher levels of income. So for people who want to get invested in equities, but want to do it in a more conservative manner, this has been a really, really interesting way to do that. And I think that's really where a lot of the interest has come. The final thing I'll say is a lot of people use fixed income to get access to income. But as you saw, 7 to 9%, 9 to 11 in the tech version, super high, but not from fixed income, from equities and from options. So it could be a really interesting way to replace fixed income there.
Cool. I'm conscious on time, so I think what would be quite a good way is maybe to move into the last two slides. Is like, to your point, where's the income coming from, and then settling our sort of scorecard, I suppose, in terms of a list of things that investors should be aware of and what they should expect from these types of products. Obviously, we can provide more information other times by Andy and team, but maybe we flick a couple of slides forward, please.
Perfect. So if we jump on 2 slides, that's the one. Perfect. And so, if you sort of invest in this, where does the income come from and what should you expect? So we take the global as an example. So you should expect between 1 to 3% income coming from dividends from the underlying equity portfolio. Remember, that's a sort of more defensive, lower volatility equity portfolio, which is actively managed. The second way you can see income come through is from the options. So we are selling index call options that gives away a little bit of return from the future and to pay out today as income. And together, that will give you, between 7 to 9% income. The third piece is, we want to give you a portfolio which should give you some, but not all of the market upside. So income from dividends, income from options, and a little bit of the market participation should get you to the total return picture.
And just to put some context, so obviously April was an incredibly volatile market, which is good for these types of strategies because you get a load of income derived from the underlying derivatives. The NASDAQ one was kicking out a yield of almost like 14-15% over the April because of that volatility. So, think of these products in the context of the macro environment. Volatility is good for these things, but also a kind of sideways, slightly more down market is good. But let's flick on to the next slide. Just to sort of, Ruairidh, if you could summarize kind of the key tenets that we should be judged upon, I suppose, when investors invest.
Yes. So if you invest in this product, we think these are the 5 things you should expect from it. Regular income paid out monthly, a product which has less volatility, less beta versus global markets, and that when markets fall should go down less. Together with the income and a little bit of appreciation of the underlying equity portfolio should give you a good total return. The final thing, we see a better Sharpe ratio. So that's basically total return versus the volatility. So this can be a really interesting way to invest in a multi-asset portfolio because it can give you, a lot of benefits. So we think if we can do these 5 things, our investors should be pretty happy.
Good stuff. Thanks very much, both of you. Really interesting stuff, as always. As you say, we're coming towards, probably got about 10 minutes left of the webinar. So I will do a quick demo to show everybody on the webinar how to buy these JP Morgan ETFs on InvestEngine. In the meantime, though, please do feel free, keep the questions coming. If we don't get a chance to answer them today, then we'll do our best to get back to you after the webinar. But for now, let me see if I can share my screen. So here we have a nice dummy account to walk through. Once you're logged into the platform, either on your phone or on the web browser, you can either kind of open a new portfolio or select your existing one. I'm just going to scroll down. I've obviously got loads on here and select the DIY portfolio, which at the moment we've got 50% in equities, 50% in bonds. So all we need to do is click Add Securities in here, nice and simple. And then to keep things even more simple, we have a nice JP Morgan tile, which you can click up here. And then that brings up all of the JP Morgan ETFs on the platform. You can see they've got a really good range of ETFs on here, including the full REI range that they were talking about and the premium income as well. And actually, the premium income one is right at the top here. So let's go with that one as our example. We can just click that one. And that brings up the ETF page, which has got a nice description of what the ETF does and all its various stats down there. We want to add that to the portfolio. And you can see in the top right here, that's now been added alongside our 2 existing ETFs. So the next screen is where we figure out how much we want to invest in here. I'm going to put 50% of the portfolio into this one here. Then we review and continue, and we can see based on the look through how that would affect your portfolio if you went ahead with the changes. So you can see that our weightings in North America slightly increased by this, slightly higher weight in Europe ex UK, slightly higher weight in Japan. And then we can do the same thing for the sectors as well. So it has your sector breakdown and all the way down to your individual holdings breakdown as well. So if we like the look of that, we click save and continue. We get a nice green tick saying that everything's all been updated. Very good. And we should now be able to scroll down and see, here we go, that our target weight in JEGP has been increased to 50%. It's currently sitting at 0. So what we need to do, if this was an existing portfolio, is to rebalance the portfolio. So all you need to do is you just click on the options and there's a rebalance option in there. If it's a new portfolio, you just need to click on the invest button. That would just give you a one-off top up. If you want to do regular investing, pound cost averaging, you just click the set up a savings plans here, and it gives you a nice option of how often you want to top up and what amount you'd like to top up on a regular basis. So it is really as simple as that. It's a very straightforward platform. And I can see we've had quite a few questions coming in, so I'm going to jump quickly into the Q&A. So bear with me while I bring up the Q&A and see if we can find some questions to ask you both. Okay, here we go. First question here on, let's go with this one on the premium income ETFs. Which market environments are those ETFs likely or designed to work best in?
Great question. So let's sort of take that in turn. So, worst possible environment for this strategy would be a rapidly rising market. So these strategies were selling index call options. So we're taking returns away from the future to pay out today as income. So if we think about last year, 2024, great year for markets. Driven basically by the Magnificent Seven, so US technology, and markets went up very quickly in a straight line. For these sorts of strategies, that's quite difficult to keep up with. So markets were up, I think, about 18%. This strategy was up about 10%. So quite a lot less. If you think about a great environment for this sort of strategy, what we've seen so far year to date, really volatile market environment. When markets are volatile, we'll be generating more income from the options that we sell. And if markets fall, this strategy should fall less. So at the height of the sort of market, or sort of the lows of the market depths this year, the global markets were down about 10%, and this strategy was flat. We had a more defensive equity portfolio, didn't fall as much, and we generated income from selling the options. So that would be a great environment. I think where a lot of people are interested in this strategy right now is if you have a range-bound market, a market that doesn't go up too much or down too much, but a very volatile environment, that'll be a really good environment for these strategies, because we should keep pace with the broader markets, but generate really nice levels of income from the higher levels of volatility. So, I think that would be a perfect outcome. But I think it's really important to think about where you can win and where you can lose in these sorts of strategies.
Yeah, I think that's important. We did have a question here. Somebody saying, it sounds too good to be true. Better growth, lower risk, very high income yield. What's the catch? And I guess that is the catch, right? Is that you have kind of more protection on the downside. You have a nice recurring yield in a range-bound market. But when the market goes gangbusters, you probably forego a little bit of that return.
Correct. Yeah, exactly.
Good stuff. We have a question here on the income options for the ETFs. Are they accumulating or distributing, and how often do they pay dividends? I guess I can actually answer that one from InvestEngine side, because on the platform, all the ones that we have are distributing share classes. But if you do want to reinvest the dividends, it's really easy to do so. You just turn on the auto invest feature, and then that'll turn your distributing share class into basically an accumulation share class for you.
And we pay every month as well.
Perfect. Thank you very much. Quick question on the REI ETFs, how do the research analysts who spent quite a lot of time going through, their combined experience and how much you spend on research and that kind of thing, how do those analysts select the stocks that go into the portfolios? Is it purely quantitative? Is it qualitative? Is it a mix of both? If you could just touch on the research process a little bit.
It's a really good question. So it's basically 100% fundamental. So these analysts are forecasting, long-term earnings, and when I say long-term, I'm talking 3, 4, 5 years from now. So, if you take the example of Apple, we're interested in how many iPhones Apple are going to sell this quarter, next quarter, next year. But where we spend a lot of our time is thinking, how much is Apple going to earn in 3, 4, 5 years from now? That sounds hard. It is hard, and we certainly don't get it right all the time. But we think across these 80 analysts, given their decades of experience, the fact we cover 2,500 companies globally, we think we get it right more often than we get it wrong, and that's obviously hugely important starting point to build these sorts of portfolios. So it's bottom-up fundamental. It's long-term forecasts. Our analysts are meeting with management, meeting companies, and really trying to think long-term about where this business could be going. And we do that consistently globally across every sector and every region.
And so these analysts are focused on one sector each. And what they're doing, obviously, what everything that Ruairidh said, is they're basically, from when they do all those earnings forecasting, they then rank all their stocks within the sector from the best to the worst. And these portfolios are obviously plucking out, hopefully, all those best ideas, but in a very risk-controlled way, because as we know from the presentation, this is a very low tracking error solution. So we might love Apple, but we could only have 50 bip kind of overweight, so that we didn't move our risk too much.
Exactly.
Yeah. Well, however they're doing it does seem to be working. Going back to the kind of premium income strategy, how does that compare with simply investing in other high yielding assets, like dividend paying stocks, corporate bond, REITs? I think there might even have been a slide on this where you had to kind of line them all up side by side. But it might be worth just fleshing that out a little bit for the listener who's got the question.
Yeah, I love that question. That's a great one. So if we compare, let's say, the global strategy to like a sort of high dividend ETF, firstly, this is going to deliver much higher levels of income. So a sort of high yield dividend ETF is probably between 3 to 5% dividends. This is doing 7 to 9, so obviously much higher. Also, the underlying construction will be quite different. And so overall, you should expect our strategy to have much better downside capture, i.e., when markets fall, this should fall less. It also means that on the upside case is true as well. So in up markets, we're perhaps not going to keep up as much as a dividend ETF, but we'll give you low volatility, capture less of the downside, and give you high levels of income. And what's really interesting is actually these two products tend to be quite different. Underlying, they hold different stocks. High dividend ETF is looking for stocks with high dividends. We are looking for stocks which are lower volatility and more defensive. So I'm sure if you used the tool that you demoed, if you combine those two strategies together, a high dividend and our product, they could be quite complementary, because underlying they're holding different things, but with our strategy, you get a really nice boost to income.
Lovely, very succinct. Thank you very much. We have actually just hit 5:45, so I'm afraid that is just about all we've got time for. I can see there's been lots of questions coming in. If we haven't answered your question today, then we'll try and get back to you over the next few days. We do keep a record of all the questions. You can always email support@investengine.com with your question, and we'll get back to you that way as well. If you want to find out more about any of the ETFs that we've spoken about today, either the REI range or the premium income range, just click that JP Morgan Asset Management tile at the top of the investments page. And as you saw, you can find all the details there. Okay, all that's left for me to do is to say thank you, Ted. Thank you, Ruairidh, for your time today. I think that was a really good discussion. Thank you also to everybody who's joined in for dialing in. And I look forward to seeing you on our next webinar.
Thanks, Andy.
Thanks, Andy. Thank you all.
Thanks very much.